In just a few weeks, Canadians will be heading to the polls. The snap federal election has been called for April 28th. And of course, the economy and the volatile trade situation with the US will be top of mind for many voters.
Yeah, I would think it's fair to say that the economy will be the biggest issue.
That's Rebekah Young, Vice President and Head of Inclusion and Resilience Economics at Scotiabank.
I think many Canadians are thinking about it in their own pocketbooks, in their own household. What does it mean for our jobs, for our income that we rely on?
She's our guest this episode to tell us about a new Scotiabank Economics report she co-authored. It outlines how the election could be an opportunity to think about how we make the Canadian economy more resilient and less vulnerable to external forces.
Yeah, absolutely. It really is about how you make sure we get on a stronger economic footing, whether or not we face the tariffs. This would leave us in a better position at the end of the day.
She'll explain this vision for stronger economic growth, the challenge she and her co-author have posed to campaigning politicians, what Canadians should be thinking about when they head to the polls, and much more. I'm Stephen Maurice, and this is Perspectives. Rebekah, welcome back to the show. Always great to have you on.
Thanks for having me.
Okay, we're going to jump right into this. We now know that we will be voting in a federal election within the next few weeks. And you recently put out this very timely report, which basically has a very specific challenge to the political parties about the Canadian economy. What is it that you're asking for here?
Our main message for any future leader of the country really is two-part: be bold and be accountable.
Okay. So we'll get into the specifics of that in quite a bit of detail. But first, your report is called Owning the Podium in Canada's Federal Elections. What does that mean?
Lots is going on in the world right now. Lots is going on within the country. But I think it's fair to say the country's been thrown into a bit of an existential crisis, that the growth model we've relied on over the last few years, even over the last few decades, is being upended, both at home and abroad. So if you think of immigration, that era is largely over, slowing down. But now the geopolitical trade wars and the whole era of globalization looks like it's reversing course. Those are aspects that have really put a lot of wind into the sails of the Canadian economy and the global economy for that matter. So now we're trying to figure out, what does the world look like going forward and how are we going to adapt very quickly? Mm-hmm. So essentially what we tried to do is seed some of the thoughts of what are some of the challenges facing the country, but more importantly, how do we create that bolder vision of what we need to do to create an environment for stronger growth? Ultimately, we are trying to create a vision for stronger living standards, or stronger welfare for Canadians.
Okay. And you had a very specific prescription, or at least specific outcome that you think it would be good to see and that we should be working towards. Can you tell us what that is? Because it wasn't just, sort of a generalized, we need to work on growth and productivity on other things, although obviously it includes those. But you have a very specific, you attached a number to this. Can you tell us a bit about that?
Yeah, and let me set the scene. Canadians haven't been feeling very good for the last few years. We've had high inflation, we've had high interest rates. And so even if the metrics tell us things are pretty good, seeing numbers like per capita GDP declining. And so, at the end of the day, ultimately what Canadians want are higher living standards. Mm-hmm. And our best proxy for that is income. So what's the household income you have to spend on the stuff that you need to invest in things like education, home ownership? As an economist, one way that we proxy higher income, higher living standards over the medium term really is that GDP per capita metric. So basically, GDP is the value of the goods and services that we produce as a country divided by our population. So basically, what's the amount of stuff we're producing per person in the country? And that's not a perfect proxy for living standards, but over time, it gives you a good sense of, how much more are we producing as a country? And that translates into higher income. So our call really was, let's be a bit bold here. If ultimately political leaders want to create a vision or an aspiration for creating a better country, better living standards, set a target that's clear, measurable, and accountable. So we suggested GDP per capita. We get those numbers out very regularly. We can calculate it very quickly. And we picked a number. We said 2% per year, aim for a 2% growth. that very roughly would translate into about $1,200 per household per year. Now, that may, not sound terribly ambitious to some Canadians, but it in fact is quite ambitious. And that we've been looking at over the last 2 decades, probably that growth has been more in the order of 1%. And if we look forward, it's probably tracking less than 1%. So, ratcheting that up to 2% would be pretty bold for a political leader to come out and say, hey, we've got a plan. This is our vision. This is our kind of our North Star. We want to get the Canadian economy producing more. And this is ultimately going to translate into better living standards. But importantly, also by establishing that goal is to create the frameworks, the policy framework. So what are the pieces of the puzzle that they're going to put together, sort of a macroeconomic picture of how they're going to get to that goal. And importantly, it then allows measurable progress. And so if politicians are not meeting those goals, there's an accountability mechanism. They have to face the Canadian public and explain, why they haven't met that target. And most importantly, what corrective action they're going to take.
Right.
This isn't new for other sectors in the economy. Even if you think, for example, corporate sector, every quarter, companies like banks face shareholders. We have an expectation of what the performance will be. And if we fall short of that, then leaders are held account to both to corrective action as well as to market pricing. And also the Bank of Canada has a very clear target. And 8 times a year, the governor has to get in front of cameras and get in front of key stakeholders and explain where inflation is sitting, where they see it's going, and if it's not heading to where they think it should be, or if it's not where it should be, they need to explain what actions they are or aren't taking to get there.
Okay. Well, just take a step back. You mentioned a little bit sort of the historical perspective of it, but I wanted to talk about why you think the challenge is necessary. And you mentioned how growth in GDP per capita had been relatively low over even the last couple of decades, and I think even declined in some of the last few quarters. Why is that? How did we get to that point where we weren't seeing the type of growth that you're saying we should be aspiring to?
Well, there are a whole host of factors. And if I can give you just kind of this 60-second, couple decade history, is that if you look back in time, when were things going really well for the country and for the globe for that matter, you can go back to the 80s. And so at that point in time, we saw that per capita number growing north of 2.5% a year. Now, that was globalization. That's when the world was opening up and trade was opening up. And there are a lot of drivers for competitiveness and productivity. And so it was a real boon for the global economy and the Canadian economy. So we saw both GDP per capita, household income, really growing pretty exceptionally. Fast forward the next decade into the 1990s and even the early 2000s, that was really the internet age. So we had lots of gains in GDP and productivity as these new technologies were taking hold and proving useful in businesses and other facets of life. So at that point, we still saw that per capita gain north of 2%. Then we were hit with the global financial crises, and we saw a lot of damage to the global economy. And so through that recovery period, then we saw those gains slow, and they were somewhere around 1.5%. We hit then 2015, and in particular in the Canadian economy, we had a lot of changes going on in the extractive sector, and particularly in the energy, oil and gas sector. What we saw is a sharp decline following the 2014-15 oil price shock. We just didn't see investment picking back up after that shock, and it has been on decline since then. So that was a big driver. That is a big chunk of not just the Canadian economy, but also the driver of productivity as one of the most productive sectors in our economy. Obviously, then you get to kind of the final chapter of the story, which was the pandemic. And what we saw in the Canadian context was just this explosive population. And we didn't see capital investment. Basically, we didn't see investment in the tools keep pace with the number of people we were adding to the economy. And that's where we actually saw this per capita number turn negative. And we saw a lot of red signals that now this per capita number is negative, where we'd gone from, north of 2.5% and slowly ebbed down to 1.5%.
Okay. Let's get into what sort of recommendations you might make, or what are the policies that a government might implement that would help us achieve these goals? I mean, you mentioned capital, obviously, that's a significant requirement for any of the things that we might want to do. But what are some of the specific things that governments can do from a policy perspective to advance this agenda?
Well, first, let me say a few words about the capital investment that are needed, because it is a little bit scary at first blush when you look at the numbers, when you crunch the numbers as we did. And so to be consistent with that 2% per capita growth that we talk about, that essentially would require sustained growth in capital investment in the country, somewhere in the order of 15%. So we're talking double-digit year-over-year growth. That is tremendous. We've never done that on a sustained basis year over year in the country. And it translates into about an incremental 60 billion in a country that annual investment is somewhere, just north of 300 billion. Basically, as a country for the last few years, we've been more or less investing just a little bit more than depreciation. So the capital stock, or the pool of capital tools that we have in the country, have more or less flatlined. So we are talking about just a fundamentally bigger level of investment that is going to be needed.
Are you talking about government expenditures here, or is this all in private sector as well, private sector capital expenditures?
That's a good question. So it is both. So in Canada, about a quarter of our so-called pool of capital, of physical and intellectual property, about a quarter of that is government owned. The majority actually municipal owned. When you think of a lot of the municipal infrastructure, provinces are another major owner, and then federal. But by and large, if you saw a pie chart, basically the governments, plural, own about a quarter of our capital stock, and the rest is private. Now, when you look at which sectors of the economy really own or, really invest in that capital stock in the country, already just the extractive sector alone gives you, another quarter of that pie. You add in transportation, warehousing, you then are getting up to sort of 2/3 of the pie. So it's very, very concentrated. And utilities is another one. So just a handful of sectors comprise the vast majority of capital stock. And interestingly, those are also the sectors that are very highly productive. So they're producing the most value per worker, per hour when we look at it. And they also own the vast majority of intellectual stock in the country. So we do talk a lot, and we definitely acknowledge the need for more innovation, more investment in intellectual property. But this isn't just about targeted investment in sort of the new economy. It's also the traditional economies and the broader Canadian economy writ large that need to be investing in these types of technologies. But just to reinforce the point, though, that we are talking big numbers, that it is both private and public infrastructure that needs to scale up. And we talk about this 60 billion just to give an order of magnitude. So 60 billion adjusted for inflation on top of an annual investment that's roughly 330 billion in a typical year. So that is a very big jump. Now, if you want a little bit of maybe it's not as ambitious, or maybe it's not that difficult as the numbers might suggest, you can go back in history and look beneath the headlines and not just the aggregate capital stock, but look at sectors, what's been going on in sectors. And very clearly, we've seen the extractive sector capital stock basically being gutted. So if we even said, let's bring our, energy or extractive industry capital stock back up to its peak from 2015. Let's look at our utilities, another big contributor to capital stock. It's been flatlining for the last few years, even though we know there's huge demand for electrification. What if we think about bringing that back to its peak a decade ago? Layer in government really, saw a surge in investment following the global financial crises. If you just looked at those three parts of the economy alone, you'd already be talking about 70 billion annual, just going back to historic peaks. So you start to say, if we are thinking a bit more ambitiously, if we are saying we've done it before, how do we do it again? That might make it a little bit more palatable.
So there is some precedent to get back there. It's not like a pie in the sky dream. It's something that the country has been able to do in the past and in theory could do again in the future. How do you divide up the responsibilities there between the public sector, what governments can do, and I guess the national level, obviously it's the federal government, and what the private sector can do. How big of a role does government policy need to play in that?
It's definitely a shared role, so I don't think that we can be finger pointing that it's one or the other. I think that we know that business investment has been lackluster. We also know that public investment has kind of stagnated and has been kind of difficult to roll out. So it's definitely a shared responsibility. And quite frankly, today we should be looking at it as a shared opportunity, not just a shared responsibility. We hear a lot people referencing about the own goals. So, yes, we're in a very difficult, uncertain global environment right now. We can't control a lot of stuff that's going on beyond our borders, but there is actually a lot of stuff within our own borders that we can control, where government does, quite frankly, have a big responsibility. The one that we're hearing about a lot is interprovincial trade. Mm-hmm. That's basically a non-financial investment that all levels of government need to come together and figure out and kind of dismantle those barriers. And that can unleash greater competitiveness, greater investment alone. We also know that the regulatory burden in terms of getting things built, getting projects online from start to finish, we know indicators like the World Bank's doing business, huge challenges in Canada and, getting from A to Z when you want to do something in the country. So there are lots of areas that are not about bigger investments with a price tag on them, but just about how easy or difficult we make it to do business within our own country. So I would say those are a couple of areas. I think a third area of a bit of our own goal issue that we need to sort out is around taxation. Now, I think we've heard over the years, many organizations, including the IMF, and now, we should likely see it in platforms, is that, let's look at our tax architecture. Is it structured around enhancing growth? We also shouldn't fold in there a review of our transfer program, because the transfer program is a way of redistributing to make sure that we aren't leaving people, regions, sectors behind. So if we look at that through the lens of, are we sure this is the right structure in today's economy to really drive competitiveness, to really incentivize business, to incentivize careful risk-taking, to take advantage of some of these opportunities? These are all the things that we can do irrespective of what's going on around the world. And importantly, there's stuff that if we're facing a worst case scenario and facing, lots of sort of damaging policies outside of our borders, this stuff is really good insurance to make sure we get out on the other side in a better position than we would be otherwise.
Right. Yeah, I think one of the positive aspects of the current situation we're going through with tariffs and geopolitical situations that you referred to before is that I think there is more discussion around all of those things that you were just talking about than there has been. Those are long-standing Canadian problems, interprovincial trade barriers, regulation, and so on. But it seems like there's more serious discussion about trying to address those now than there has been in a long time.
Yeah, absolutely. And one thing I would say too is that we are likely going to need new approaches or new ways of thinking, at least temporarily, in this period of heightened uncertainty. So if you think right now, we're seeing this in survey data, we're seeing this anecdotally, nobody knows what's going to happen. It's beyond the realm of an economist to predict what's going to happen. Yeah. And so it's not surprising to see that basically individuals, businesses are kind of frozen. They've paused, let's wait and see how things unfold. And that takes a toll. The longer that persists, the deeper it hurts the economy. And so we are likely going to have to think it's not just necessarily going to be enough to see interest rates come down or to see investment tax credits being a bit more generous. We may need to look temporarily at, are there different tools that we can use to bring down that capital cost, to take on some of that risk of investment temporarily. And I say temporarily because really is to kind of shore up or front run some of this uncertainty to still get businesses investing in this period of heightened uncertainty. Because at the end of the day, It takes time from the moment a business decides to make an investment, to execute, to translate into material results on the ground, and especially in the pocketbooks of Canadians. So there is a bit of patience, and that might explain why in the past that governments shy away from measures that enhance business growth, because it's not immediate. It's not the same as saying we're going to cut a check tomorrow to every Canadian household. Canadians feel that right away. When they enact policies that are about spurring business investment, it's not as immediate. And so that has been the challenge. But ultimately, this is really only what is going to drive stronger growth, stronger per capita growth, and ultimately what is going to drive stronger household incomes down the road. And so I think the opportunity right now is that I think there's a stronger appreciation of this is what it's going to take, especially facing the uncertainties from south of the border.
So you mentioned some of those structural issues like interprovincial trade barriers, regulatory issues. Those require lots of cooperation between different levels of government and all of that. It's going to take a while to fix. In the short term, we still need more of that capital investment to be taking place more quickly. What are some of those short term, and I think you described as temporary measures that could be taken in order to encourage that kind of investment? Are there specific ideas around how that could happen?
We do talk about one possible option just as an example, but it would be a matching grant. So basically governments could say, like, we will front 25% of your capital investment. We will match 25% of what you do now. We will only do it for, say, the next year or the next 18 months or 24 months, but time defined. So businesses don't wait. They see the opportunity on the table is that if they make this investment now, that grant incentive from governments could offset or effectively reduce that investment risk for the business. So that would be different than, say, other measures that are being talked about is immediate expensing. And, if the US moves there, Canada probably wants to go there, but that still doesn't necessarily address the time challenge or the time horizon. Businesses still may say, yeah, we welcome that and we need it for competitive risk reasons, but we're going to wait till next year to make our investment when things are clearer. And that's similar with investment tax credits. The challenge also being with some of these other tax or investment incentives is that does favor bigger established companies that have a profit from which they can deduct some of these credits. So I think we're not being super fussy about the precise design, but mostly the message being we have a lot of uncertainty temporarily. It's in the country's interest to figure out how can we really spur immediate and pretty substantially at scale investments in these industries.
Right. And probably acceptance of, at least in the short term, substantially higher government spending.
Yes. And we put a pretty wide range around that estimate. Again, going back to kind of the spectrum of public investment versus private investment and somewhere in the middle of the shared responsibilities. So you do have some areas, and I give an example perhaps in the extractive industry where it's mostly about removing some of the red tape and kind of getting out of the way of whether it's interprovincial relations in terms of pipelines or, you name it, the issues that have impeded investments in that sector. So part of that is that may not need public dollar incentives versus further down the spectrum of public investment or public-private investment in infrastructure that's more traditionally perceived as publicly owned assets. So I would say we put a wide range around those estimates because quite frankly, we're going to need a little bit everywhere. This points to another impediment, if I can say that, is that we have to think not only about the source of capital, what can government incent with its balance sheet and what can private companies invest based on the cost of capital and the opportunity, but also we have to be thinking about the investable landscape. So we need to think about what are the opportunities and the projects and the assets that we should be rethinking as to how we open them up so they are more attractive for investment. And I think that especially is pertinent when it comes to thinking about that longer short-term capital that we hear a lot about in the pension funds, for example, that we shouldn't be mandating them or forcing them. You have to invest in Canada. We should be looking at what is it here that makes Canada really, really attractive. And I think right now we have an additional premium that we are all of a sudden, we're much more secure than what otherwise had been, a slowly dwindling group of economies that are trustworthy partners. So I think those are advantages, but we still need to go further and say, what else will make capital want to come to Canada or want to stay in Canada?
Right. As we said off the top, it looks like we'll be going to the polls in a matter of weeks. What are you going to be watching for in a campaign?
So we're definitely watching very carefully what's coming ahead. Now, I'm an economist, not a politician, and thankfully so, because they are going to have a lot of eyes on a lot of balls. Mm-hmm. The very obvious one is just the negotiating tactics with the U.S., because that clearly is going to determine the direction of the Canadian economy to what does materialize. And they're going to have to be deciding retaliation, because that also has an impact on the economy. So that's going to be one area that is going to determine the trajectory, broadly speaking, of where the Canadian economy heads. But they're also now going to be thinking about not just the typical election platform. So what we know, election times, governments make lots of promises. Governments of all stripes make promises. So we've looked at the last few elections, and over the 4-year mandate, what we see is typically leading parties promise somewhere net of $50 billion in spending, often higher spending number, and then they find revenues or cut expenditures elsewhere. But the bottom line is they promise big numbers in the order of $50 to $70 billion over 4 years. So they're going to be kind of divining what sorts of policies do we lay out as we go to Canadians and seek their vote, seek their support. At the same time, though, they're going to have to be sort of looking for 2 for 1. So we have to devise a platform pledge, but we have to be thinking about what if this is going to be rolled out when the economy is really hurting? What if we are in a world where there's a serious trade war and the economy is sliding, and we're going to need to think about that more traditional so-called fiscal stimulus, basically kind of juicing near-term demand? At the same time, they're going to be thinking about there is another side to a trade war. Eventually, we get to the other side, and we're going to be licking our wounds, and we're going to be assessing the state of the economy. What can we do now to make that other side look a little bit less bad? And that's where our call for being bolder, going for growth, really comes into play, because if we are facing a sharp downturn, leaders are often and rightly focused on making sure the immediate or the urgent are taken care of. Yeah. But we should also be making sure we make those investments so that on the other side, things look better. So our call right now, especially in this period of uncertainty where we don't know which direction we're heading, is that making these big, bold investments in expanding our ambition in capital investment and, intellectual property investment, these are the sorts of policies really you can't go wrong, whether we are facing a slowdown or whether we are going to kind of skirt through this and it turns out to be a lot of threat. Either way, we're going to be better off 2, 3, 4 years down the road. And so if you're aiming to lead the country, I think you need to paint a vision that comes up with a policy package that can withstand and even perhaps thrive in this type of forward-looking environment.
So very briefly before we let you go, Canadians heading to the polls in a couple of weeks, what should they be looking for in an election campaign?
I think at the end of the day, Canadians should be looking for accountability. We have elections pretty much every month, somewhere in the country at some level of government. So we're used to politicians coming out with grand promises and promising to make Canadians' lives better. So I would say for Canadians, look through some of those promises and look for what it's going to do longer term for the economy, because ultimately that is going to be what establishes or enables stronger household income.
Rebekah, thank you so much for joining us. Really appreciate it.
Thanks for having me.
I've been speaking with Rebekah Young, Vice President and Head of Inclusion and Resilience Economics at Scotiabank. The Perspectives podcast is made by me, Stephen Maurice, as well as Armina Lagaya and our producer, Andrew Norton. For a transcript of this episode, as well as other stories, insights, analysis, and thought leadership, visit our website, scotiabank.com/perspectives. We'll see you next time.